Welcome back to the deep dive. Now, if you've been following along with our previous looks at KIP REIT,
Yeah, we did that Q2 FY2025 analysis and the broader earnings outlook one before that.
exactly. So we keep a close eye on this REIT. Well, the new report is here. Q3 FY25 results just landed, plus some other interesting bits and pieces.
And we've done what we always do, gone through the official report, of course, but also checked out some YouTube analyses, news articles, and, tried to piece together the management's thinking.
Right. So the mission today, it's not just reading out numbers. We want to pull out the really important stuff, understand how KIP REIT actually performed, where they seem to be heading.
And what it all means for you if you're trying to get a good handle on them.
Perfect. Okay, let's jump straight in. Q3 FY25 performance. What are the big headlines financially?
Okay, so comparing this Q3 to last year's Q3, the gross revenue figure really stands out. It's up 61.1%. That's RM 39.54 million.
Wow, 61%. That's huge. Where's that coming from mainly?
Well, the report says it's better performance from 7 KIP malls, plus the new acquisitions kicking in DPU's, TF value, and that CR35 industrial asset.
Ah, okay. The acquisitions are making a difference, though.
Definitely. And looking at the revenue split, it's still heavily retail, 95.6%. Industrial is the other 4.4%. So retail is clearly the engine.
Got it. And presumably that strong revenue flowed through to their earnings, NPI?
Absolutely. Net property income, their MPI, jumped 51.9%. That brings it to RM 27.48 million.
Okay. Solid growth there, too.
Yeah, and what's quite interesting is even if you strip out the new properties, the existing KIP mall portfolio, just on its own, grew NPI by a strong 23.3% year-on-year.
Oh, really? So the original malls are pulling their weight, too?
Exactly. They specifically mentioned St. Rosie Mart opening at KIP Mall Sinawang helped. So it shows the core assets are performing well. It's not just about buying new stuff.
That's a good sign. Healthy underlying business. What about profit before tax?
Profit before taxation, that was up 35.1% to RM 13.82 million. So still very healthy growth.
Still strong. Okay.
But the report does note this was slightly held back by higher management fees and also higher borrowing costs. We should probably touch on those fees later.
Right. Makes sense. Increased assets, increased activity, costs go up.
Yeah. And despite those costs, the total comprehensive income, basically profit after tax, also rose by that same 35.1%, hitting RM 13.82 million. If we look at realized profit after tax, which is closer to actual cash earnings, that's a 19.8% increase up to RM 14.33 million.
Okay, so core profitability still looking pretty good despite those rising costs. Now, the big one for many listeners, what happened with distributions, the DPU?
Right. So income available for distribution, that grew nicely, up 35.7% to RM 14.18 million.
Right.
And the realized earnings per unit, the EPU, that edged up a bit to 1.7305 sen from 1.6536 for previously.
No, this is the interesting part. The distribution per unit, the DPU for Q3, stood exactly the same at 1.600 sen.
Ah, unchanged.
Yeah.
Even with all that revenue and MPI growth. Unchanged for the quarter, yes. It does include a non-taxable bit, about 1.117, they estimate, which is nice for some unit holders from a tax perspective.
But no increase. Any thoughts on why? Maybe holding cash back.
It does make you wonder, doesn't it? Maybe retaining earnings for those acquisitions we know they're keen on, or perhaps for improving existing malls. It's a question mark for this quarter.
Definitely something to note. Okay, let's zoom out a bit. Look at the year-to-date numbers, the first 9 months of FY25. Does that paint a similar picture?
Yes. The 9-month trend versus last year is also strong. Gross revenue up 38.4% year-to-date, hitting RM 96.24 million.
Still very robust growth over the 9 months.
And NPI is up 33.8% to RM 68.77 million. The revenue mix for the 9 months is slightly different, 94.8% retail, 5.2% industrial.
Okay, so that industrial slice is getting just a tiny bit bigger over the longer period. Small diversification happening.
Seems like it, yeah. Profit before tax for the 9 months grew 14.8% to RM 35.88 million. Realized profit after tax is up 10.3% to RM 36.4 million.
And the distributions year to date.
Ah, this is key. Income available for distribution year to date is up 15.2% to RM 36.97 million. And crucially, the DPU for the 9 months has increased. It's 4.7820 sen compared to 4.7000 sen for the same period last year.
Okay, that's important context. So flat for Q3, but the overall payout for the year so far is actually higher than last year.
Exactly. So the annual trend is still positive on the distribution front, even if this specific quarter was held steady.
Got it. Now, how does this latest quarter stack up against the previous one, Q2 FY25? Is the momentum continuing quarter on quarter?
Yes, it looks like it. Comparing Q3 to Q2, gross revenue saw a big jump 31.8% up.
Sequentially. Wow.
Yeah. NPI rose 27.1% and profit before tax increased 15.3% compared to Q2.
So strong growth compared to last year and compared to the immediately preceding quarter.
Right. And the report again points to both better underlying mall performance and the contributions from those recent acquisitions. It suggests they're integrating well and consistently adding value quarter after quarter.
It really seems those acquisitions like DPULS and TF Value are giving them a significant boost.
Okay, let's shift gears to the balance sheet. Their overall financial position. What's changed with assets and liabilities?
Okay, asset side first. Total assets have grown quite a bit, now at RM 1,485.25 million. That's up from about RM 1,136 million.
Quite a jump, mostly property value.
Primarily, yes. Investment properties are the main driver, up to RM 1,420.42 million. Now, on the other side, total liabilities have also increased, as you'd expect. They're at RM 657.23 million now, up from around RM 458 million.
Okay, so liabilities up too. Where's that increase coming from? Borrowings mainly.
Yes, and specifically, there's been a big shift. Non-current borrowings, longer-term debt has increased significantly. At the same time, current borrowings have decreased.
Ah, so they're taking on more long-term debt, likely for those acquisitions, and maybe paying down shorter-term stuff.
But that looks like the strategy, yes. Locking in longer-term financing for these long-term assets.
Makes sense. What about the equity side, NAV? Total Unitholders Fund, or NAV, did increase. It's RM 828.02 million now. That's after distributions. But interestingly, the NAV per unit actually dipped slightly to RM 1.0368.
Down slightly per unit. How does that happen if total NAV is up? More units issued.
That's the likely explanation. Probably related to funding those acquisitions, maybe some units were issued as part payment or through placements. It dilutes the per unit value slightly, even as the total fund grows.
Right, and their gearing ratio, debt levels.
Gearing stands at 41.0%. It's up from before, which is expected given the borrowing for acquisitions.
41%, still within typical REIT limits, but definitely creeping up.
Exactly. It's manageable, but certainly a number you'd want to keep watching closely, especially if they keep buying properties.
Definitely. So growing assets, slightly diluted NAV per unit, and rising, though manageable, gearing. Let's circle back to the drivers. We know acquisitions are key. What else is influencing these numbers? You mentioned fees and borrowing costs earlier.
Yeah, the report is pretty clear that the increased borrowing is mainly funding the property buys. The other factor is a manager's management fee. It's higher for two reasons.
Okay.
One, the fee rate itself changed, went up slightly in FY25. Two, the fees are linked to performance, total asset value, and NPI, since both of those have gone up significantly.
The fee automatically goes up too.
Precisely. There's a base fee on assets, a performance fee linked to NPI, and an acquisition fee when they buy something. So better performance in gross means higher fees. It's designed to align interests,
Yeah, the manager does well and the REIT does well. Makes sense. Can you just quickly remind us what's actually in the portfolio now?
Sure. End of Q3, they had 14 properties. 10 are retail. That's the KIP Malls Tampoi, Kotatingi, Masai, Senawang, Malacca, Bangi, Kotawursan, plus Aeon Mall, Kinta City, DPU, DE, and TF Value Mart.
Okay, the 10 retail assets.
And then 4 industrial properties, all located in Pulau Indah. So still very much retail focused, but with that industrial component there.
Predominantly retail. Got it. Okay, looking ahead then. What's the management saying about future prospects and their strategy?
They seem pretty positive. They expect those recent buys, especially DPULS, to keep contributing strongly to earnings going forward.
So, expecting continued impact from those.
Yes. And a core part of their strategy, they keep emphasizing this, is their focus on community-centric neighborhood malls. They see that as key for staying relevant and resilient.
That community focus comes up a lot. What about more growth? Are they still in acquisition mode?
Oh, absolutely. Big news on that front. Actually announced after Q3 ended, they've proposed buying 4 more retail assets.
4 more. Wow. What are they?
It's KIP Mall Disa Coalfields, a Lotus's hypermarket in Indira Makota, Kuantan, then 3 shop offices and a car park also in Kuantan, and another commercial building in Kuantan. Total price tag is RM 118 million.
Okay, significant expansion plan there. How are they funding that? More debt.
Partially through a proposed private placement. They're looking to issue up to 160 million new units to help pay for these.
Ah, the private placement. That connects back to this potential NAV per unit dilution we talked about. That's a lot of new units, potentially.
It is. Existing unit holders will definitely be watching that closely. It signals a very clear intention to keep growing that retail portfolio.
No kidding. What's the bigger picture goal here? Is there a long-term target?
Yes. Insights from TA Research and KIP REIT's own Going for Gold town hall suggest a pretty ambitious target. Scale their assets under management, their AUM, up to RM2 billion.
$2 billion. Within what time frame?
Within the next 3 years. So quite aggressive.
That explains the acquisition drive.
It does. Alongside that, they're also focused on enhancing their current assets. They mentioned KIP Mall Tampoy specifically is getting upgrades. Plus, prudent capital management and exploring more growth in both retail and industrial, always with an eye on sustainable DPU growth.
So enhance, acquire, manage debt, grow DPU. Sounds like the REIT playbook. And they're sticking to the distribution policy.
They reaffirmed it, yes. Intend to distribute at least 90% of distributable income quarterly and over 90% of taxable income for the full year FY2025. The tax structure at the trust level helps them achieve that high payout.
Right, the pass-through nature of REITs.
And one final update on acquisitions. Remember those industrial properties they agreed to buy earlier? They completed the Cheras one back in February 2025. For the other two, in Port Klang and Johor, they've gotten an extension to finalize things. So progress on the industrial side, too.
Okay, so very active management, completing deals, planning new ones, upgrading existing malls. Let's touch briefly on the team itself. Any insights from the sources about who's driving this?
Well, you have Dato Dr. Syed Hussain as chairman, notable connections to the EPF. Dato Ong Kok Liang, the MD, co-founder of the KIP Group, brings that property development background.
Right, the founder connection.
Then Valerie Ong Pui Shan is the CEO, focusing on strategy, asset management, and ESG sustainability stuff. Michelle Ong is an executive director involved in spotting investment opportunities. Plus, independent directors bringing finance and governance experience. It seems like a team with relevant backgrounds.
And presumably, their strategies are what's delivering these financial results we've discussed.
You'd have to connect the dots that way, yes. The strong revenue and NPI growth clearly stem from their strategic decisions, both managing the existing malls effectively and executing those acquisitions.
The acquisitions seem particularly impactful recently.
They do. And that community mall focus seems to be working in terms of occupancy and shopper traffic, driving that organic growth we saw. Their ambition, that RM2 billion AUM target, certainly shows a management team focused squarely on expansion.
Okay, I think that covers the key points really well. Let's try and summarize the main takeaways for everyone listening.
Sure. So KIP REIT's Q3 FY25 showed really strong growth in revenue and NPI. That's coming from both their existing malls performing better and the significant contribution from recent acquisitions.
And they're not stopping there. They have plans for more retail acquisitions, funded partly by issuing new units, while also progressing on industrial diversification and upgrading current properties.
The DPU for this quarter was flat, which is something to note. But the year-to-date DPU is actually up compared to last year, and they've restated their commitment to high payout ratios.
That AUM target RM2 billion in 3 years, that really highlights their growth ambition.
But, and this is important, that aggressive growth comes with rising debt levels, the gearing is up, and the planned private placement means potential dilution for existing unit holders.
Which leads us to the final thought for you to chew on. This strategy of rapid growth through acquisitions, using debt and new equity, how sustainable is it in today's economic climate?
Right. How does this aggressive expansion fit with KIP REIT's overall value proposition? And maybe more importantly, how does it align with your own investment goals and what level of risk you're comfortable with? Definitely worth digging into the details yourself based on what we've discussed.
Great points. Thanks again for joining us for this deep dive. We'll catch you on the next one. Stay curious, stay informed.